$1 million is quite a lot of money, and it might feel like there's no way for a normal person to ever achieve such a large, impressive net worth. But what if I told you that the average person living on an average income could not only achieve this, but it might be a lot easier than you ever thought? In this video, we're going to break down the exact math and show you not only how long it would take, but also how much starting money you would need to surpass the $1 million investment goal by investing strictly into the JPMorgan JEPI ETF. Now, the great thing about investing is that there's multiple vehicles that can all get us to the end destination. And this is mostly due to long-term investing, which is a strategy where an investor buys and holds investments for a prolonged period, usually more than 5 years, with the expectation of generating significant returns over time. The goal of long-term investing is to benefit from the power of compounding. This is where investment gains are reinvested over time, resulting in exponential growth in the investor's portfolio. Like we mentioned earlier, when it comes to long-term investing, there's many different ways to get to the end goal. But for this video, the investment vehicle is going to be the JPMorgan JEPI ETF. Now, if you're newer to investing and you're not familiar with the JPMorgan Equity Premium Income ETF, known as JEPI is, it's an exchange-traded fund that seeks to provide investors with exposure to U.S. large-cap equities while generating income through a covered call strategy. JEPI primarily invests in a portfolio of large-cap U.S. equities, which are selected by JPMorgan's investment professionals based on a proprietary quantitative model. The portfolio is designed to track the performance of the S&P 500 index. Now, JEPI also employs a covered call strategy, which involves selling call options on some or all of the equity holdings. A call option is a contract that gives a holder the right but not the obligation to buy a specific underlying asset, in this case the underlying equities held by JEPI, at a predetermined price known as a strike price, on or before a specific date known as the expiration date. Now, because JEPI does sell covered calls, it earns the fund a lot of money in the form of premiums. JEPI distributes income to investors on a monthly basis, which is comprised of dividends received from the underlying equities held by the fund, as well as income generated through the premiums from the covered call strategy. And as we said at the top of the video, we are going to make this a very, very realistic amount of starting money and amount of money added to your portfolio every single year, because we want to build a portfolio that's going to be very attainable for the investors out there that have an average salary. So the starting principal for this portfolio will be $5,000. Now, of course, you could start with less money or more money in your portfolio, but I figured $5,000 was a relatively small, obtainable amount to start in a portfolio. The annual dividend yield is 11.4% because that is JPMorgan's JEPI ETF's trailing 12-month dividend yield. Now, for the expected annual dividend raise for JEPI, we're going to keep it at 0 because we're not really going to expect JEPI to raise their dividend from here all that much. And with the JEPI ETF, the dividend does move up and down, so we're just going to go off the trailing 12 months and leave it right there. Now, the payment frequency is going to be monthly when it comes to JEPI ETF, and we are going to have DRIP turned on. This means that all the dividends paid by JEPI over the years are going to be reinvested to buy more shares of JEPI, which is how the compounding effect is really going to take place. For the annual contribution, we have $6,000, which equals $500 per month added into the portfolio on top of the dividends reinvested. Now, once again, I want to make this sort of realistic, and I think someone earning an average salary of around $40,000 or $50,000 per year could most likely come up with around $6,000 to contribute into the portfolio if this is going to be their main retirement plan. Now, for years invested, we put 30 years, but again, you could change this depending on your age. I'm currently 30 years old, so I put 30 years, meaning that I'd be 60 years old before I would touch a single penny out of this portfolio. So here we go, guys. Here is the entire breakdown. You can see year number 1, the principal is at $5,000, and the annual dividends are already at $600 per year. The annual dividends are so high, much higher than the S&P 500 would be, much higher than SCHD would be, because JEPI does offer a very high starting yield of around 11.4%. Now, this is going to allow the portfolio to reinvest quite a bit of money on a monthly and yearly basis, which is going to buy a significant portion of more JEPI shares ongoingly and really get that compounding snowball to grow. By year number 2, the principal in the portfolio is already up to $11,600 plus, with almost $1,400 a year in dividends. So by year number 2, with all the numbers that we started with, this investor would already be earning over $100 per month in dividend income from JEPI. Now, skipping a few years, by year number 5, the portfolio is worth around $36,000. And again, all of these numbers are in theory. Obviously, these numbers could go way up and way down. This is just a model, a look on what it could look like in the future. And the dividends by year number 5 are at $4,300 already. So by year number 5, you're already seeing the compounding take place. And your yield on cost is moving up significantly as well because of the reinvestment activity. Now, scrolling down, by year number 10, this portfolio already surpassed $100,000 and is earning over $1,000 per month in dividends. So just 10 years down the road. So just by investing a relatively small amount of money and adding $500 per month into the portfolio, this portfolio is already generating over $1,000 per month, which I'm sure any of us would be pretty excited about. By year number 15, this portfolio is at $219,000, generating $26,000 per year. And by year number 22, this portfolio already surpassed $500,000 worth of value, generating $65,000 plus. Now, this is interesting because this portfolio isn't even all that large, considering it's generating more than the average salary in the United States. $65,000 of dividends could most likely cover most or all of our bills at that point. And again, this is just from a relatively small amount of money to start with. If we keep going down further and further, we can see that by year number 30, all the way at the end, this portfolio's value is $1.425 million plus dollars. And it did take around 27 years for this portfolio to cross over the $1 million threshold. At the end of the road, year number 30, this portfolio is generating $171,000 plus in annual dividend income. Now, the main point of this video is to show that the power of compounding interest does take effect as long as an investor is willing to stick with a plan long term. Now, of course, the numbers can be much larger or much smaller depending on which investment vehicle, which ETF and or stocks you want to put into the compounding dividend calculator. And of course, those out there that are willing to invest as much as possible every single year and buy more shares of high quality dividend stocks and dividend ETFs, it's only going to supercharge the process. If you enjoyed this video and you enjoy content like this, make sure to please drop a like in this video and subscribe for more. Thanks as always, guys, and I'll see you in the next one.